Hi, I'm Bill Baruch, president of Blue Line Capital. I'm here with our analyst, Jannis Meindl, for the Triple Play podcast. As always, we got a great macro backdrop, and we'll move into three individual companies, stocks that will have a little breakdown for you. Let's get to it. Jannis, start us off with the macro.
Yeah, thanks, Bill. So we're back at it with macro data to kick it off with. Of course, we talked about that briefly on the last week's podcast too, but we had CPI, of course, coming in rather hot at 0.5 on a month-to-month basis versus what was expected. We also had hot PPI data, and one of the main shifts that everybody was talking about was basically how the Bureau of Labor Statistics shifted more of the weight of future CPI prints to shelter and away from more cyclical components like the energy component. So shelter, meaning rent and owner's equivalent rent combined, will make up 1.5% more in future CPI prints. They shaved off 1% from the energies. So maybe a little bit less cyclicality. And what they're hoping for is that as housing rolls over on a lagged basis, that they will receive some of that benefit there. We also saw that retail sales, of course, came in blazing hot. And Bill, you'll touch on that. At 3% month to month. And one of the more interesting components, though, I find quite stunning is how on a real basis, so retail sales itself is a nominal number, meaning as prices go up, that number naturally goes up with it. But on a real basis, you see that retail sales are only back to 2019 trend. What does that mean? The consumer is actually not receiving more value for the additional dollars that they spend. And that will be a theme throughout today's podcast with consumer health and whatnot. Then we also had PPI, of course, also coming in above expectations. And while the year-over-year number is now down to 6%, I find most concerning that some of the 3-month annualized numbers within the print were quite high still. So you still had the energy deceleration, you still had transportation coming in on the low end, but then the 3-month annualized, so that's sort of a more local measure rather than the base comparison distortion that you'd receive from a year-over-year number. You had the 3-month annualized over 5% for food. You had it just a tad below 4% goods, less food and energy. So not a lot of the follow through there in terms of supply chains easing up. You had trade services near 5%. And then you had construction coming in really hot at 7% on a 3-month annualized basis. So these are a lot of really interesting developments. And within CPI, I thought that median CPI really being a measure of the broadness and the breadth of inflation came in at 8%. For the January print, that is. So maybe the broadness is concerning, and that's also what we're seeing getting reflected here with Treasury yields hanging in there pretty high, the 10-year near 4%. Bill, why don't you take over and run us through some of the data and what you're seeing on the macro side?
Yeah, you highlighted at the end there, rising yields. We got the 10-year closing on 4% here Tuesday, and then the 2-year, it's right up 4.75, closing in on those November highs. Might have even been a new high close yield today. It's been our theme that the economy, was going to be soft landing to almost a no-ish landing because the consumer, the tight job market, and this narrative's played out. Everybody's really getting very negative on the economy. It's something we use to lean on, talking about what this January retail sales number that just came out. I know we talked about a lot of this last week, so we won't rehash it much, but as we look to the data right now, we got flash PMIs today. The services PMI was expected to contract, came in above 50. That's an expansion. Services, it'll continue to be, sort of a backbone to what is a steady economy right now. And some of the data as we look ahead, really, it's going to be core PCE index later this week, but it's really on to February jobs. And is it going to be next? I think it's next Friday now. So is the February jobs report going to be what we saw for January? And if that's the case, I mean, it's really going to start really pricing in 50 basis points from the Fed. We're starting to see the market 50 basis points in the March meeting alone, but we're starting to see the market today with a little bit of weakness. The S&P trading down to 4,000. Starting to price in this little more of a hawkish Fed, a little bit of froth coming out of the market. We'll have to see how the coming days go. It will be interesting, certainly. A lot of data. Inflation is still hanging around. So, it's going to be interesting couple weeks here ahead here as we move into that March Fed meeting. But moving on to the stocks here, let's jump right into it. AT&T is the first name we have. It's a stock that we added last week, and we actually sold Coca-Cola and bought AT&T. Now, we don't dislike Coca-Cola, but one of the things was multiple is hanging right around 24. It's an expensive name. We've been bullish the consumer. That's been our story. But if the Fed has to come in and slow this economic growth down, tighten policy even further, then I think the consumer will ultimately get hit in the end. And that kind of worries me with some of these higher valuation consumer names. So we moved into communications, which we look at this as sort of a staple-ish multiple of 8. You got a dividend upwards near 6%, and it's an unloved name right now, AT&T. No one's really wanted to have anything to do with AT&T or Verizon unless you're a dividend manager, really ultra value oriented, and it's something I think that could fit in the portfolio here right now. Be a little yield substitute, as the market may kind of shake off some of this froth. The other big backbone is the CapEx. I mean, I think not just AT&T, but some the other communications companies have a lot of 5G investments that they're not going to have to continue to invest in. It's definitely going to moderate. I think that's positive as we look forward. Yeah, I mean, just the overall the churn rate is something else. I think as you look at it, when you start talking about other communication companies, you look at T-Mobile is really the big brand that's attached to a lot of their loyalty building over the years, and AT&T really competes with them in a churn rate. You look at 97 basis points churn rate for AT&T, 88 basis points for T-Mobile, but we got Verizon up there 138 basis points. So we like the loyalty, we like the reduced CapEx, we like the space with a low multiple, we like the dividend. I think it's just a place, not calling it only a hideout, because I think it's unloved. So as a commodity trader at heart for many years, you look at things that if everybody's already bought, who's left to buy, or everybody's already sold, who's left to sell. I think this name that's unloved can become more loved and more liked, and that's going to be a tailwind in time to come here for AT&T. But Jannis, why don't you hop in with some data that you're seeing here?
Yeah, I would largely echo some of the same points that you already brought up. Of course, the big thing is that the company guided 2022 and now the upcoming 2023 year, those will be the peak spending years for 5G as the company continues to invest in the expansion of 5G. When you look back on past cycles on 3G, on 4G, these are like multi-year cycles really, where migration to that new technology play out. And in the advance of that new technology getting adopted by consumers, you see that heavy investment flowing into the space. So if we just take a look at the spectrum licenses, AT&T has invested about $70 billion since 2011. And the compound annual growth rate of that investing into these new licenses stands at around 8%. But when you zoom in a little bit and you compare 2022's number with 2020, you can see that there was a real step up in how much they invested into these new spectrum that they acquired. The compound annual growth rate since 2020 is up to near 20%. And if you look more broadly at the industry writ large, you can see that from 2017 to 2021, the entire industry, meaning all telecommunication players from Verizon to T-Mobile to AT&T, invested about $150 billion into new spectrum frequencies, and that compares against roughly $40 billion the prior 5 years. So you can see that real step up as companies have kept investing more into new technologies. And then I think one thing that's encouraging is the fact that you have that loyal customer base. While AT&T is trailing just a little bit behind T-Mobile on postpaid customers, they still have compound annual growth since 2020 of more than 4% compared to T-Mobile around 6%. You have strong stickiness in the prepaid space. And then I think exactly what you said with them comparing favorably against Verizon, which is also a high dividend play. But Verizon's subscriber base has sort of flatlined while AT&T has been able to further expand their customer base. And one thing too is there were some issues with the 5G rollout and the concerns that the FAA echoed in terms of spectrum interference with the airlines. And as a result, a $23 billion investment that AT&T made, that 5G rollout will fully kick in at the end of this year. So some of the benefits that are coming from past spending are only going to kick in at the back half of this year. And I think as spending comes down, more free cash flow is ultimately going to flow to investors. Bill, why don't you take over and run us through the chart?
Yeah, just going back here quite a few years in the chart. It's I think the one thing to kind of notice here is we're retesting some previous lows. We're trying to break out of this downtrend. So you may have a little bit of a inverse head and shoulders as well. It's all about follow through. We'll get some answers here in the coming months. Is this stock able to really kind of get out above those 2022 highs? Is it able to kind of run out above there? If it can, I think there's quite a bit of ceiling. Back up to the 2021 highs. It could really start to move. So we're at a very critical juncture here. For now, I think it's a good place. A little more than a hideout. Got their dividend, some uncertain landscape as well. Tech's had a really good start to the year. So maybe this is a spot to sort of rotate into a little bit. We like it right now. But yeah, interesting chart. Some promise there. Let's move on here to Lowe's, which is right in the forefront here with some of the retail earnings. Home Depot reported earlier today. They're down more than 7% here after close through the session. Lowe's, though, follows like it typically does, down a little over 5% on the session. Home Depot as well as Walmart both highlighted some caution on the consumer moving forward, kind of like what I was talking about in the macro side of things. Home Depot also missed on revenues, too. Now, the consumer, that's really what I was talking about it, is if the Fed has to tighten policy further, then you could start to see this consumer get a little exhausted. I think that when you could take some of these companies that really have a good pulse on the consumer, they're looking bigger and broader out. It's safe for them right now to sort of give some lower guidance. So I think that's a little bit normal, and kind of just take this in stride here right now. We don't own Home Depot and we don't own Lowe's. It's just sort of a name that it had a big run out of the pandemic, and here at the end you'll see the chart. But it's overall, a good way to put Lowe's is it's sort of the little brother to Home Depot. I mean, a lot of these numbers, compound annual growth rate, revenues for Lowe's 5.8% against Home Depot 7.2, CAGR net income 10.5 for Home Depot 14.6. Really got the margins on this 11% for Home Depot compared to Lowe's 7%. So if Lowe's becomes a little more efficient, that's where it could become attractive. I mean, they brought in Marvin Ellison, who spent 12 years at Home Depot, potentially carrying some of that, maybe some of that efficiency into Lowe's. It's not extremely expensive, 15 forward multiple. It's down from 20. I mean, it's not a big enough difference right there to write home about. But as we move on to our third name here, it's going to be interesting because it's our theme is look for names where the multiples move down pretty significantly compared to the trailing 12 months. So I think that's something that's attractive. Something too, I think with Lowe's, as we move into the second quarter and we kind of look out a bit, they become very important with this sort of home planting, spring planting at home, gardening. They get a great business from that. It comes a really good portion of their business. If we've had pretty moderate weather so far this year, if that maintains and through May, that could be a bigger boost to Lowe's business, something to keep an eye on, something maybe to front run it, from a weather basis. But yeah, obviously I think it's just, right now, name that we're cautious on. And there's a lot here to unpack. I mean, especially given the Home Depot's earnings. But Jannis, I'll hand it over to you to jump in.
Yeah, a lot of good points made. Again, I would largely echo all of those. And I think as you spoke about with earnings this morning, we saw Walmart really highlighting the shift away from discretionary spending. One of the good things about Lowe's is that only 1/3 of their overall revenue comes from discretionary spending. The other 2/3 are non-discretionary maintenance and repairs, meaning that home owners don't really have a choice whether they want to get that repair done. They just have to. So there is some resiliency there. And then, of course, you have that operational upside, perhaps with Marvin Ellison as the new CEO, perhaps bringing some operational efficiency that they also implemented with Home Depot. One fundamental aspect of this business is why Home Depot has outperformed Lowe's. One sort of reason behind that is that 50% of Home Depot's customers are professionals, whereas only 25% of Lowe's customers are professionals. So maybe some upside there in terms of implementing new strategies. I think one more broad macro theme of sorts is, of course, that the U.S. most people who have taken out a mortgage in 2020, 2021, and even before then, they have locked in a really low mortgage rate. Maybe more than 90% the company thought have locked in that low mortgage. And so people are not really going to move out of their homes. They're going to spend more time and money on home improvement rather than looking for a new home. And as more homes, historically, the vacancy rates of homes is really historically low. So there will be more housing supply at some point. But as the age of overall homes increases towards above 40 years, there'll be a lot of repairs that need to get done. And combined with a mortgage rate that maybe stays a little bit more elevated, as the Fed might need to get a little bit more aggressive with a relatively strong consumer still, there is probably some upside to this business, although you need to ask yourself about the base comparisons and where we're coming from. A lot of these things are probably baked into the cake at this point. Bill, I'll kick it back to you for the chart again.
Yeah, I mean, a big name. I went back here of the chart, which you'll see in a second, prior to pandemic. So a couple questions. I mean, this is really what you want to ask yourself. What kind of market are we looking at here? Is this, look, pre-pandemic, it was sort of this trend in the channel. Have we begun this trend in the channel? If you can see here the last, say 6 months or so, is that what we're looking at now? It definitely found support before one of the latest legs, coming out of the pandemic. You see that highlighted in the purple box. Or is this sort of a little bit of an ascending wedge that could turn down sharply? And we have a sort of a head and shoulders top building. It's certainly going to be an interesting story here to play out. Again, we don't own this name right now. We don't own Home Depot right now. Although we've been extremely bullish on the consumer in general, we weren't so bullish on consumer stocks. I thought there's just a number of other ways we were really bullish on industrials, as well as some of the technology names. Obviously, it's sort of one of those things that how much could be potentially priced in, and how much steam is left. These, I mean, look at Walmart and Home Depot. These were names that you leaned on in this first quarter of this year, and then you waited for their earnings to come out and expected strong earnings. I mean, you're very disappointed here after today. So it is a place, although again, we've been bullish on the consumer, we've been very neutral on the consumer stocks. But yeah, I think a lot of questions will be answered here in the coming months, coming weeks, really here, looking at that chart. So let's move on here. The big name to finish out is AMD. Obviously, this is a front and center name. You have NVIDIA reporting earnings after the bell tomorrow. So we wanted to cover it this week. I think really to highlight right out of the gate, the next 12-month multiple on this 26. You look back at the trailing is 93. So this is one of those big revenue. Sort of looking at this already being digested. Now, data centers, were up 42%. So there's positives here. I think that's really, as this business sort of can shift. They've digested Xilinx, from last year, and the question remains though, the consumer revenues side down 51%. This is the quarter 4 earnings report. Gaming revenue down 7%. So there's a lot of questions to be answered here. But on a positive, I think the data center, more of the higher performance chips that they've really begun to focus on in the last, say, 5 years. I think that's a real positive. I mean, again, this is just a name that really got a lot of oomph, from 21 into 22, and before the correction in 22. So it's see the chart, it's definitely found a good point of balance. One thing I really will say though with the data centers, if I didn't already say it, was it's 1/3 of the revenue now, and it's a higher margin business. So you see, one of the themes that we've been talking about in this podcast is sort of having these diversified revenues streams. And you look at name like this, the semiconductors, they've sort of been able to maneuver. There's the addition of Xilinx, maneuver and find these diversified revenue streams that also may not bring a whole lot of overhead, because they've really stolen the CPU business from Intel. Now Intel is focused on fabrication and the development and building out these expensive expensive, industry, part of the building, part of the process. And AMD is not going to have that sort of overhead. So I like looking at a name like this at the level that we are, at the multiple that we're at now. We don't own AMD. NVIDIA is a very core position of our portfolio, so they trade similarly at times. We're definitely excited to see what NVIDIA brings on Wednesday after the bell, but it's going to be. We expect a volatile environment. We've been trimming NVIDIA after this rally, after this big move here. Even trimmed a little bit more today as the market broadly turns down. So we're in a place here that. Listen, it's stay moving with the market, be ready for whatever comes, be nimble, and that's kind of how we're looking at things right now from a positioning standpoint. Jannis, I know you got a lot to say about this name. I'll hand it over to you right now.
Yeah, of course, this has been a major turnaround play ever since 2015 when revenues bottomed, and ever since then, the company has seen 29% compound annual growth rate of their revenues. You have to remember between 2012 and 2016, they didn't have a single year where they had a net income profit. They always ran a loss, even though they disposed their foundry business, which you spoke about. That's really the capital intensive part of the chip design, chip manufacturing side of the play. And they disposed of that asset in the late 2000s, which is a positive now because they can really focus on their core expertise. And then you really had two pioneers who came in. Lisa Su, who's now the CEO, still came in 2012. And you also had the legendary chip designer, Jim Keller, who also came in that same year. One thing we had going on in 2011, AMD introduced two different CPU designs, two different architectures for CPUs, which they wanted to target Intel with. And they also had one chip GPU design that came in that same year. All of these designs disappointed to the downside, and that's why you had that prolonged period of negative net income. Then you had really the turnaround with years of work and the Sin CPU chip design that came in really under Jim Keller's leadership. And ever since then, since 2016, it's been a turnaround story as they focused on the higher echelon of gaming CPUs, of GPUs, and really trying to play the data center trends that are probably secular over the long term. So this has been a major turnaround story. They have been able to eat away at Intel's market share. I think Jim Keller, he used to be with Apple before he came to AMD. He made it really clear that the different mindset between Intel and AMD when Apple was going to buy a chip between Intel and AMD. The designers came in. Intel thought that Moore's law, so performance optimization, was basically dead. AMD remained ambitious as they were refocusing their brand to higher end chips, and it was ultimately AMD that came out on top. Where's the next inflection to the upside going to come from? That's sort of the question mark. Right now, it's really going more towards the higher end data center chips, where they are also expected to receive higher margins from and diversifying their revenue stream from the client and gaming business. So yeah, it's been a major story. Of course, the stocks run tremendously. They've integrated Xilinx for nearly $50 billion last year. They also in the design space. So you have a lot of different cross currents here. Chips are a cyclical business, so that's important to keep in mind as maybe we talk more about the consumer and all of which we have talked about today. So cyclical business, it's been a major turnaround story. The next catalyst is really the question.
Yeah. I agree. You said right there, the next catalyst, what's it going to be? I mean, from a chart standpoint, obviously this was a big sell. One of the stocks that really came in pretty big in 2022. It found support though. I mean, we had this sort of uptrend line, but I think we're at this point of balance, and that's really the previous lows. You go back to it was the 2021 lows, 2020 lows, and the question is, this point of balance, do we battle here? Does it hold out above it? Or, is it a broader sell-off that takes this thing below it? Is it NVIDIA earnings tomorrow? Which I don't think it's going to be one of those events. I think it's going to be more of a broader market event if this is something that's going to see this fail at this level. I think there's been a lot of construction semiconductors this year broadly. And, we'll see if this thing can hold ground for some of the construction that's already built. But, we're not chasing names. Like I said, we've been trimming NVIDIA here. So, yeah, we took the podcast a little longer today than typical. But, thanks for joining us. Obviously, we have a lot of information we want to pack in for you. Check out that chart book because there's a lot of stuff there, a lot to digest. And thanks again for joining us. Bill Baruch is the founder and CEO of Blue Line Capital. All opinions expressed by Bill and podcast guests are solely their own opinions and are not intended to provide specific advice or recommendations. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Understand your financial condition before investing. Blue Line Capital, its staff, or its clients may maintain positions in the securities discussed in this podcast.